Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Rahul Khanna, who is an FX strategist at TraderMade. Rahul, as ever, thank you very much for coming in today.
Thank you for having me.
Pleasure. Now we're going to look at three currency pairs today, with the dominant theme being the US dollar. Before we actually look at the three pairs, what's your take on the dollar moving into the end of the year? Are you bullish or bearish on the dollar itself?
I think dollar is not going to be fairly bullish, but in the short term it looks like there are certain drivers that could push it a bit higher. But we don't see dollar breaking the highs that we've seen previously, post-Trump elections. So we're not going to see dollar break those highs, but we can see some short-term rally in dollar. And then as ECB moves and other banks move, then we'll see dollar start to sort of weaken, because even though there is this positive theme with the new Fed chair being pointed, potentially being a bit hawkish, we don't see how Fed can move with such a massive balance sheet and balance sheet normalization. It will be a struggle for Fed to be able to do the changes that is needed to push dollar significantly higher, given other central banks, especially the ECB, is also looking to move towards tightening phase. And the only thing dollar can really rally against massively is yen, because we've seen Shinzo Abe being re-elected, which means and emphatically, which means that he can push ahead with his agenda as long as he push the reforms for the pacifist constitution. We can see Abe continue with this policy of expansion, and which means that yields will rise on the dollar side and globally, and which means that dollar could rally against yen massively. But for other currency, it would be difficult, given that there is now this broad theme, the yields are rising, and like I said previously, in a few meetings, that the overall theme is the global data is improving. Oil is improving. Yields are sort of bottoming. We're seeing this initial signs. We don't see anything that will abrupt this. So that's why it will be a struggle for dollar to massively rally against the likes of euro, even sterling or Aussie and Kiwi over the long time frame.
Understood. Well, let's you put along a few charts, starting off with the Kiwi against the US dollar. Obviously, elections in New Zealand. Talk us through the chart from a technical point of view. We've seen a sell-off in the Kiwi. Where can it go from here?
Yes, so the current sell-off is on the back of comments from PM Marden, who she said that they're going to change the mandate for Royal Bank of New Zealand. But what she said is it doesn't change on a fundamental level what Royal Bank of New Zealand can do to push the Kiwi dollar down. They've already been trying, so it's not like they've not been trying. And wages and employment and the global data has been sort of fairly positive. So they can't really hold New Zealand's strength when the domestic picture improves and risk appetite improves. They can only do a limited amount. So this is on the back of that. Yes, they will be more protectionist, possibly pushing Royal Bank of New Zealand to control the currency. But as we've seen, the other banks, like the US dollar or ECB, their mandate is to look at both employment and inflation, and even they sometimes struggle to control the currency. So on a fundamental level, nothing changes. But yes, there is fears that there could be more rhetoric coming from the political quarters, which means that we can see this current slide extend further. And also this ties in with the short-term theme, which is the ECB is going to tighten. Dollar, like I said earlier, Fed is looking to have a new Fed chair, which means they could be more hawkish. There's Trump tax plans, so which means the yields in the low yielding currency are sort of rising, which means that likes of Aussie, likes of Kiwi will struggle over the short run. But still, it doesn't change the fundamental, like I said, the underlying theme, which is that market is improving gradually. So low yielding currencies yield rising in the short term is actually good for the risky currency in the longer term. So as we can see in this chart, we've seen the current decline. There is some key level at 68.90 90, which is broken just now, and 68.20, I think the line below the 68.90. These are the short-term level, but I think this can also break given the sentiments we have in the market right now. But if you look that in 2015, late 2015, it completed a base. It had dipped all over 2015. So we've seen that even though this could be a short-term setback in the medium-term or long-term time frame, we will see support. There's a great amount of support around 66.50, as we can see, and I think that's where the buyer is going to come in, because the people who are going long risky currency understand that this doesn't fundamentally change anything. So I think those are the levels 66.50 where if you're looking for medium term opportunities, that's where you're going to look to buy, even possibly sooner, around the 67 area, I think. So I think that's what this chart shows.
Understood. And looking at the dollar versus Canadian dollar, we've got the Bank of Canada meeting today. It feels like interest rates really aren't going to move until the start of next year.
Yes.
Hopefully they don't surprise the markets, or maybe they do if you're trading this pair. Now, just talk us through the technical levels and where this can go from here.
All right. So as we've seen this phase that we've seen since mid-September to early September, that CAD has gradually weakened against the dollar. This is the same thing that you said. It's the unwounding of the rate hike that was earlier expected. So the market was expecting BOC rate hike in October, but we've seen the CPI miss and data being sort of surprising to the weak side, which means that market now expect the BOC not to go ahead with the rate hike, and there's only a 2 basis point chance of priced in, which means it's fairly neutral. But having said that, given there's a dollar positive theme going on there, with yields on dollar rising, it's broken key 2.4% level, which means that there is some room for this rally to move higher. Now 128.37 is a decent resistance level, and I think it could test that if the BOC is neutral, and if they're dovish, then it could even break that level. But in the short run, even if let's say they look past this current weakness in data, even then we could see a 1% move down. But as long as it's above 124 area, the overall thing is that this is probably basing, which means we can see CAD lower over the coming weeks. So I think these two are crucial level, 2837. If it goes there and nothing new is said, and we see a rejection, there could be opportunity to sell at 2837, taking profit. But if we see a move down after a dovish BOC, then there's opportunity to buy there, because overall, there'll be opportunity to build dollar CAD long positions, and that's what this chart basically is saying.
Okay, good stuff, and we'll obviously wait the Bank of Canada later on today. Euro dollar as well, technical point of view, head and shoulders there. Where potentially can it go from here? And if we see it up at 120, obviously the ECB and Draghi isn't going to particularly like that, and we'll try to talk the euro down. But from the charts and technical point of view, what is it telling us now?
So as you rightly pointed out, there's a head and shoulders pattern. There's also a small head and shoulder that got completed in September, but now there's a gradually bigger one, which points that it could potentially actually have a setback. And if you look at MACD is also sort of trending down. It's still around that level, crucial level where still hanging on with a thread. Which means that there is potential for it to still move lower, but like I said, this is a technical view. A lot depends on what ECB is going to do, and that is why the sort of stop area is probably higher. Just to look at look past the short-term noise that might be created with the ECB meeting. So I think if there's a short-term bounce and nothing significant happen in the meeting, then there'll be opportunity to go short euro dollar. But I think key risk now is about QE tapering. Market is already pricing in, looking at a more fundamental level. Market is already pricing in around 200 billion pound QE, over the next say 9 months, 200 to 250, which is roughly over 9 months. We'll have a 30 billion or so purchases, which will be down from the previous levels, but and massively from previous levels, but still there'll be a tapering, which means that eventually it'll be phased out. This is what market is expecting. So if ECB does deliver around the 270 billion to 300 billion QE tomorrow, then we can see potentially euro dollar sort of dip, because this will be, it won't be significant. What would be significant is if QE ECB comes out in the Thursday meeting and say it's going to be over the next 6 months, and it will be less than 200 billion to maybe 150 billion, which means it will be a lot shorter phase, which we did see with the Fed back when they started tapering. They went fairly quickly, 10 billion. They phased out every month. And sort of dollar reacted accordingly. So I think in terms of this chart, it depends on what ECB does from here on. If they do deliver a very aggressive QE tapering, we could actually see that 120 level break, and then easily there could be a 1.5% short up. And this would mean that there's a drastic shift at what ECB is trying to do, and the data has been sort of on their side of lately. So I think that's what I think the risk is from the ECB meeting. Technically, it is still looking toppy. Still look that they might deliver what market is expecting, which means even if they might be short-term bounce, there'll be sellers trying to take it to around the 114, 115 level, which is more sort of a level which will tie in with even a dollar positive story. So I think technically looking to it 115, but a lot depend on what ECB does tomorrow.
Fantastic. Well, we look forward to what Mr. Draghi and the ECB has to say. But in the meantime, Rahul, thank you very much for joining us here on Core Finance.
Thank you.